Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. So we have a Fed meeting coming up on the 2nd, and there's an expected 75 basis point rate hike, coming. The potential for another 75 after that. Markets are very attuned to unemployment, CPI, any economic data that the Fed may use to make this decision. Because, as they say, you don't want to fight the Fed. So risk-on assets have certainly suffered considerably since rate hikes began. Markets had a slight reprieve last week when this Wall Street Journal reporter, Nick Timiraos, released a story that suggested the Fed may be stepping down their hikes in December from 75 to 50. Now, we'll see what the Fed says on November 2nd, but markets got very excited to hear this news. Some people misunderstood this, I think, for a pivot. If anything, it potentially signals that the Fed cannot raise as fast as they wanted to. They can't go as far as they wanted to. Maybe they think things are breaking. Maybe in their eyes, they don't want to see certain things breaking. A bit of a guessing game on many fronts, but we'll find out on the 2nd where their head is at and what they're looking at and what they've seen. On top of that, again, we have midterms on the 8th. So more and more volatility likely in the next couple of weeks here, which for some would be welcomed considering Bitcoin and Ethereum have been rather quiet over the past several weeks. And a bit of good news on the transactional front. CashApp, which is one of the 15 fintech apps in the US that most people use, between Venmo, PayPal, and CashApp, Apple Pay. They've added the ability to receive Bitcoin on the Lightning Network now. And the Lightning Network is layer 2, which means it's on top of Bitcoin. The on and off ramp is through the Bitcoin network. And much like a debit card system, you need to send the Bitcoin to the Lightning or take it off Lightning onto the Bitcoin network to get it out of the Lightning Network. But if you're in a circular economy, ideally, that's the end goal with everything in relation to Bitcoin specifically, is how do we pay people in Bitcoin? How do they use Bitcoin to pay for goods and services? That way there is no need for fiat on-ramping and off-ramping. Pay taxes in Bitcoin. That's slowly starting to happen. So we're starting to lay the track slowly but surely for microtransactions. We sent a transaction today internally. It's a penny. That was from a non-Cash App Lightning app to the Cash App. So that wasn't even internal. Internal Cash App transactions would be free, but this was literally a penny. It was 12 sats. And this is perfect for paying for tipping, for example, paying for haircuts, paying for restaurant meals, paying for tolls. There was this great talk I saw from Bitcoin Magazine's latest conference in Amsterdam for a crowd wall. So instead of a paywall that's single use, single access, you set up a crowd wall where there's a flat fee, anybody can pay it, or everybody can pay a little bit towards the fee. And if one person pays it, then it unlocks the content for everybody. So we're starting to see very interesting applications with Lightning on the payments front, and we definitely need an increase in not only usage, but just applications for Lightning like this. And we can look at the Lightning Network directly and look at the capacity. So like I said, it's a debit card system effectively. And we can measure the BTC that sits on the Lightning Network and extrapolate that and say, okay, maybe this is a good metric to use for usage. We can't really look at transactions because they're bidirectional and they're free. And, it's essentially just a free-flowing system where it's in one address, it's in another address, it's in all the addresses. It's definitely a finite amount, but at the same time, it's just free-flowing in a sense. So we really don't have good transactional data for the Lightning Network. This is really the best we can do is say, okay, how much Bitcoin is sitting in the Lightning Network? It surpassed 5,000 BTC recently, and it continues to rise. And with things like Cash App, I can see an increase further. Twitter, Cash App, various goods and services in various places, adding Lightning payments, free, global, instant. Nothing offers that right now. Now, if we look at the on-chain activity for Bitcoin, And Ethereum and most everything right now, it essentially remains flat. It essentially remains in a tight range. There's still activity there. There isn't growth. There isn't month over month growth or week over week growth. A lot of this at the end of the day is influenced by price. So if price slows, as it has recently, on-chain activity will slow. Again, if the end goal is a circular economy, we expect to see a continuous increase over time of on-chain activity. So even throughout the bear market, Bitcoin still has, honestly, surprisingly large amount of on-chain activity, as does ETH. ETH has DeFi to help bring those numbers higher, certainly. There's still plenty going on with Ethereum on the Ethereum network. Transaction counts still at 1 million per day. Active addresses nearly 500,000 per day. And you can see we've kind of plateaued at this level really since January 2021. For ETH, the most important thing is twofold in regards to supply. In the current staking regime, coins can enter the staking environment, but they cannot leave the staking environment. So for proof of stake for Ethereum, these newly added validators represent a supply soak on the network. This is supply that is essentially out of circulation. On top of that, they also have a burning mechanism that started in August 2021 based on transactions and fees. Currently, that burning mechanism is essentially flat, even historically, very flat. Since the merge in September, this has remained relatively flat, but is rising again. So ETH needs this equilibrium where you want to see fees rising slightly because that signals activity. At the end of the day, you want to see this fee burn mechanism kicking in because that represents an additional supply soak, and ETH has the potential to go deflationary. On top of all that, if we're talking about supply demand, something else we can watch is the coin balances on centralized exchanges, which have continued to dwindle, unlike 2018, where we saw this collapse in price, consolidation of price leading to a collapse in price, where all the while we were just getting tons and tons of supply just dumped onto centralized exchanges. That certainly appears to have plateaued relative to March 2020, and both Bitcoin and Ethereum continue to show a decline in coins sitting on exchanges. Not only that, 65% of the Bitcoin network, those coins in the circulating supply, have been dormant over the past year. So to me, this signals a few things. There aren't a lot of fly-by-night people left on a relative basis. There aren't a lot of traders left in the ecosystem at the moment, right? Most of the people here are probably more leaning towards the buy and hold long-term investor bucket than the day trading mindset. Now that may change, obviously, if price becomes hyper volatile in one direction. But as we sit here today, more and more people, by the looks of it, are squirreling away their Bitcoin, they're squirreling away their ETH, and they're either locking it up into proof of stake or they're using it in DeFi. Moving on to technicals here, if we zoom way out for Bitcoin, if we look at the red slices here, which are halvening events, every 4 years, Bitcoin undergoes a programmatic issuance reduction, and we're somewhere in between the last cycle and the next cycle. Something else we can look at here is the power law corridor, which is a line of vest fit from the previous 3 all-time highs to sort of help us out in the current environment, sort of illuminate, are we overbought, are we oversold on a relative basis, are we at a bottom, are we potentially at a top? Based on what I'm seeing here, it certainly looks like we are closer to a bottom than a top. The 200-week moving average in the green here, which we historically have entered an accumulation period near or established a bottom historically at. So it wouldn't surprise me in 6 months and 12 months and 18 months if we look back at something like this and say, yes, everything was extremely bearish. Macro headwinds were blowing astonishingly hard, but technicals on a high time frame basis are signaling a decent risk reward profile from here. Now, that doesn't mean we can't drop another 50%, right? But all the froth, all the euphoria is certainly long gone from earlier in the year. Something else I'm watching very closely is volatility, and a way to measure that would be Bollinger Bands. Bollinger Bands tighten when volatility contracts, they expand when volatility increases. We can also assign a value to the caliber of the bands. We can look at the Bollinger Band width at the bottom here. And you can see historically, we are almost unmatched for volatility contraction here. Only 5 other times in Bitcoin's history have we contracted on the weekly basis this hard on volatility. Currently, as we contract and we're below the 20-week moving average, Bollinger Bands show a bearish bias. Now that may change if we break above the 20-week moving average, which is why today especially is so interesting. When we begin to flirt with that, I think it's 21,500 level, where we go from bearish to neutral to having a bullish bias. Ideally, what I want to see from this going forward in the next 3 weeks, I would love to see red to green on the Bollinger Band width, in a sense that we're back above that 20-week moving average, really for the first time since much earlier in the year. So if we can get 2 to 3 weeks of continued low volatility with price above the 20-week moving average, then suddenly things look much more bullish in the near term than they otherwise would have been. So it's very much an if this then that situation. But right now we do lean slightly bearish. We're nearly back to neutral. It's going to be very interesting to see how we put up a fight at the 20-week moving average, because everyone at this point is looking at 2018, where we had nearly 9 months, almost a year really, below the 20-week moving average before breaking down. And there were plenty of attempts to break above that, and it just could not break above that 20-week moving average. We had a similar attempt earlier in the year where that also was sold off pretty hard. So this is another high time frame, relatively clean, high hit rate type of technical that does give a decent sense of bullishness and bearishness in general. We're also seeing a slight decline in correlations to US equities, slight rise in correlation to gold. If the safe haven, non-day trading, non-FOMO euphoria mindset is back, things may start to turn a corner here over the next couple weeks. We are still below levels I'd like to be above to be certain that we would be more bullish than bearish, such as the 200-week moving average, the 200-day moving average. Ultimately, 25K is really the level where things potentially turn bullish again, because that is not only the 200-day moving average, but it's also an Adam and Eve type of chart pattern where you have this potential for a breakout higher. So the first step in creating a trend reversal is forming one of these chart patterns that we typically see, that we're actually currently seeing the inverse of on the DXY. I'll get to that in a second. But this has tons of time to play out. Obviously, we're 5K away from even being, honestly, relatively neutral, right? But the idea here is if we can hit these successive checkpoints, the 20-week moving average, the 200-day moving average, then the discussion changes drastically from this is bearish, all the way down to, okay, this thing might start to look decent and have outperformance relative to traditional markets. So we've got some time, but those are the levels. And most importantly, honestly, is that we didn't make a lower low today, because we were contracting not on just high time frames, but even on low time frames. And if things were truly bearish, we would just sell off kind of for no reason, right? We're holding this level here, very thin ice at around 20K, 19 and a half, 18 and a half. It's very much a different story if we start to push higher here over the next week or two. ETH, very similar picture. The signal in the 20 week isn't as clean historically, but importantly, it is above the 20 week today. And you can see how many times it's tried over the past year, year to date, to hold above that 20 week moving average and just get smacked down every time. Tried twice before the merge. So things are slowly starting to turn a corner here. I'm not going to get overly excited, but even on the pitchfork, we are starting to peak above months and months of bearishness. And the macro headwinds certainly won't help us in the near term, but this is a very good sign for early. And what really helped today, I think, is the DXY started to pull back. This is the weekly chart for the DXY. It's a basket of currencies, mostly the euro, against USD. And historically, we've been very inverse to the DXY. And we've been in this extended multi-month parabolic advance, well above previous multi-year highs Now, this is the range historically where DXY has lived. And if DXY can relax week over week, crypto, those headwinds against crypto, against digital assets, relax as well. So if you want digital assets to be bullish, you want this inverted Adam and Eve. You can see the V, the U. The reason these fractals have names is because they happen so often in all markets. But what you really want to see here is this breakdown below that 110 level. If we break below 110, digital assets have a very good chance, purely based on technicals, to start moving higher. So that's all I have for this one this week. Let me know if you have any comments or questions in the video below. And check out more research on ValkyrieInvest.com.